Hello and welcome to Live Wire Markets. My name is Chris Conway. On today's episode of The Pitch, I'm sitting down with Gabriel Ng to talk through everything you need to know about private equity. Gabriel is the Managing Director of Neuberger Berman Private Equity. Gabriel, thanks so much for joining us on The Pitch today.
Absolutely, it's a pleasure to be here. Thanks for having me.
Gabriel, can you give viewers an introduction to private equity and just explain how it differs from public equities?
Absolutely. So private equity essentially is an investment into a privately held company. So investors or limited partners or LPs typically access the asset class through investments in private equity funds, which are managed by general partners or the GPs. So the GPs will typically raise the capital and subsequently deploy that into anywhere between 10 to 20 different companies over the life of the fund. And each underlying portfolio company is typically held between 5 to 7 years. And well, the main differences between public equities and private equities, there's a lot of ways to look at it. But I typically like to look at it from the lens of an investment cycle, so the buy, the hold, and the sell, right? So at the point of investment, or what we call the buy, private equity typically has a lot more scope to perform detailed due diligence, right? This could range from extensive management meetings, on-site visits, customer interviews, etc. Whereas for public equities, there's generally limited scope to perform such level of due diligence when you're buying into a stock. And second of all, during the holding period of the investment, private equity tends to take a very active ownership approach, right? So the private equity sponsors will be working with the management teams closely to drive value creation and to drive earnings growth, and ultimately with the aim of increasing the valuation of the company. And if you look at the public equities market, there's little scope once again for that active ownership angle that public investors can take in the stocks they invest into. And last but not least, on the exit. So private equity GPs have the ability to position their assets for a sale, and there could be multiple routes of generating an exit outcome. They could list the company in an IPO, they could sell the company to another private equity sponsor, or they could also sell it to a strategic buyer. If you contrast it with public equities, well, it's a lot more liquid, right? But I think you're sort of beholden to a share price that you're transacting on at the point of exit. So I hope that gives you a good sense of the asset class and some of the differences that we see.
It does, Gabriel. Thank you. Can you just also explain the difference, please, between direct co-investment and secondaries?
So starting first with direct co-investment. So this is essentially an investment into a direct portfolio company alongside a lead private equity GP. And there are several reasons why the lead private equity GP would need co-investment capital from their LPs. Number one, it's really, the deal size is just too large for the fund to absorb or to undertake on its own. So it needs LP co-investors to come in to make up the difference in the equity check. And then the second reason as to why co-investments are required is really to fund certain strategic initiatives within the portfolio company. It could be to support and fund, a strategic or accretive bolt-on M&A, or to fund the company's expansion into a new market or new growth initiatives. So that's on the co-investment side. And if you look at secondaries, I would further dissect that into two categories. Number one, you have LP secondaries, right? Essentially, this is the secondary investor providing a liquidity to existing LPs in a fund who, for whatever reason, cannot wait till the end of the fund life to generate their liquidity. So they need to sell their LP interests typically midway through the fund life cycle. So secondary investors provide that liquidity option and basically buy into the fund at that point in time. So that's one variant of a secondary deal. The second would be what I call a GP-led secondary. As the name suggests, it's initiated by the GP, essentially to move one or more of its existing assets from an existing fund to a new continuation vehicle that's once again capitalized by a new secondary investor, and hence provides liquidity to the investors in the existing fund. So those would be the main differences between those two underlying strategies.
Gabriel, let's talk about how you're investing right now. Where is Newburger Burman active in private equity markets?
That's a great question. We are active across the PE ecosystem, right? I think we want to continue to be value-added partners to our private equity GP relationships across the world, be it in primaries, co-investments, or secondaries, and still be able to generate good risk-adjusted returns. So on the primary side, we continue to invest into funds that are being raised by, cycle-tested, stable GPs that have a proven track record, and we do that across the globe. In the co-investment space, that's where we're spending a lot of time as well. We're helping our GPs step up to transactions which would otherwise be too large for their funds to undertake. and more importantly, in a time where liquidity is limited, to come in with strategic capital solutions to help them perform accretive M&A transactions or to fund certain growth initiatives. And last but not least, on the secondary side, we're a provider of liquidity, whether it's to LPs who wish to cash out on the LP positions or to lead some of these GP-led continuation funds, which we are seeing a lot of deal flow in. So essentially, we are active across the board. I would say that from a geographical perspective, our deepest markets are in North America, followed by Europe and in Asia Pacific. It's not too different if you look at the respective depths of the PE markets in these regions. And from a sectoral perspective, we're sector agnostic, but where we're leaning into is really more resilient defensive sectors. For example, education, healthcare, software, business services, essentially companies within these sectors that have a very defensible, a very clear moat and market positioning. So these are some of the opportunities that we're chasing at this point in time.
The defensive positioning, is that a function of just analysing each deal individually as it comes across your desk, or is that a strategic positioning based on the way that you view the world right now?
I would say we look at it from both a bottoms-up and a top-down approach, right? So from a top-down perspective, we'll need to like the secular tailwinds that the industry brings. We're certainly not going to be investing into capex-heavy industries or industries that might be disproportionately impacted by a down cycle. And from a bottoms-up perspective, every investment has to stand on its own 2 feet. We have a large investment team that sits around the globe that is very, I would say, proficient in performing grounds-up due diligence. And this is anything from the sector, from the company, from the financial analysis. So I would say that it's both ways, right? Top-down and bottoms-up.
There's been a lot of talk about valuations in the private equity space. Where are they now, and how does that compare to historically?
Our observation is that the private market valuations have been relatively sticky, right? They haven't corrected as drastically as we might have seen in some sectors within the public markets. The impact is different, right? As you look across different sectors, obviously, early stage, loss-making tech companies have corrected a lot more, whereas some of these other defensive businesses in resilient sectors haven't exactly corrected that much. I would say the stickiness can really be, boiled down to 2 reasons. I think number one, it's really that bid-ask spread, right? So sellers are still having that price expectations of 2020 and 2021, whereas buyers are a lot more cognizant of the current market environment and might not be able to match those pricing expectations. And as a result, the sellers don't transact, right? And you don't capture those lower multiples in the data. And that has in part led to a reduction in private equity volume over the last 2 years. The second reason is really, for the deals that are getting done, I think there's been a bias towards quality. So I would say that private equity sponsors are not shying away to pay full valuations for very high quality defensive businesses. So those valuation multiples are still stacking up if you look at high quality assets.
Gabriel, you've touched on the broader economic conditions. Just how sensitive is private equity to those changing conditions?
I would say that we're certainly not immune, right, to higher rates, high inflation, and a slower macro environment. But the one thing I would say is that there are many tools in the toolkit that private equity GPs have at their disposal to manage through that. For example, the ability to seek new avenues of growth through expanding to new markets, rightsizing the cost structure, or even leveraging technology and automation to improve efficiencies and productivity. So there are levers to be pulled. But the one thing I'll say is that, in spite of the macro environment, we as a firm, we're still underwriting to the standard private equity returns that we seek in every single transaction that we do. But it's just the levers, right? And how do you get there, right? So if you looked at the returns decomposition, right, for the deals that we're underwriting in today's market, a lot of that value creation really comes from fundamental revenue growth and EBITDA margin expansion or profit expansion. And to a certain degree as well, the ability to execute on accretive bolt-on M&A deals, right? I would see a very much less reliance on the impact of financial leverage or financial engineering, just given where rates are. And there's also less dependence on multiple expansion. In fact, we are actually incorporating, a multiple contraction, right, in our own underwriting for some of these deals that we analyze. So the bottom line is we're still, seeking the same returns, but the path to getting there looks a bit different today versus where we were in a low rates environment 7 to 10 years ago.
Gabriel, we've spoken a lot about the theory. Let's talk about the practice now. I know you can't give specific examples, but can you give us an idea of the type of deals that Newburger likes to pursue that highlights the opportunity in private equity?
Absolutely. Maybe I'll start first with co-investments. So on the co-investment side, we're looking at a lot of co-underwrite transactions. So this is a situation where the deal size is just simply too large for the sponsor to undertake at the point of the final bid. So someone like us will come in for a sizable amount of the equity, and we join the due diligence process from the very start, right? So we've had a lot of time to really build conviction on the opportunity and to work alongside the GP through the diligence process. And at the end of the day, if we do prevail in these transactions alongside our GPs, it's a much larger equity ticket that we can write to a high conviction opportunity. So we say interesting and robust set of deal flow on the co-underwriting side of things. And because there are several other players who have also retreated just because they might have been over-indexed on the private markets allocation, so they've stepped away. So I think we've been able to get pretty good market share of the co-investment deal flow. The second, I would say deal type in the co-investment space is what I call midlife. So this is us investing into a portfolio company that a GP has owned for a certain number of years. And, just given where liquidity situations are and capital constraints, they might not always be able to easily raise the capital for bolt-on M&A. So here's where we come into the picture. We provide the capital for that portfolio company to execute on an accretive acquisition, and we take a minority stake in the combined entity. So we are trying to create such win-win situations where we provide the capital solution and help the GPs get a good M&A deal done for one of their portfolio companies. So these are some of the deal archetypes that we're focusing on the co-investment space. And of course, on the secondary side, we continue to be very active, both on the LP secondaries, right? Investors, for various reasons, need liquidity. So we think that it's an interesting time to be buying into these LP positions. And importantly, as well, for some of these GP-led continuation funds, with the IPO markets being shut, there's just a more compelling need for GPs to seek ways to optimize the eventual exit outcomes. So we're there providing capital for them to, move high-performing, high-quality assets from one fund to a new continuation vehicle to give it a bit more runway. So I hope that gives you a good sense of some of the types of deals that are keeping us busy.
It does, Gabriel. Thank you so much for sitting down with Livewire.
Absolutely. Thanks for having me.
If you enjoyed that episode of The Pitch, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.